Has engulfed global markets since yesterday and is still going to be with us for some time to come. The 16th largest bank in the United States has fallen, and it is taking down global stocks, particularly banks down with it in its collapse. On Friday, investors and depositors in the U.S.'s 16th largest bank, Silicon Valley Bank, woke up to news that the bank is defaulting and seemingly insolvent, even with trillions of dollars in deposits and investors' money. The shockwaves from the collapse of another bank, Signature Bank, which has been taken over by the U.S. regulators, continue to be felt worldwide as questions are being asked about how tight is the regulation environment of the banking sector globally. Fred Razak is the chief trading strategist at CMTrading in the New York Stock Exchange, and he joins us now to shed some light and maybe tell us if we should start keeping our money under our mattresses. Fred, thank you very much for joining us this afternoon. I want to start here about who exactly is Silicon Valley Bank and who exactly do they represent?
So they're an independent bank, and like many of the banks in Silicon Valley, they represented, just a slew of venture capitalists that were looking to borrow money for high-tech and startup kind of companies. They had two major branches, mostly in Boston and obviously in Palo Alto. So they are really an important bank because they really represent some of the startup money that is being funneled into new projects and venture capitalists. So I think the shockwave is because it's so sensitive, because they really represent new kind of money that's going into the market. And their insolvency is that much more troubling in a already agitated market.
Fred, how does something like this happen in a free market age and in the world's biggest economy that is seemingly well regulated like the United States?
So you said it very well. I think seemingly regulated is the key term here. I think it's a slew of the perfect storm. Once again, we had the perfect storm in 2008, 2009 of the credit crunch crisis, and we're seeing it again, just in a different color. And not in the magnitude that we saw it in 2003, 2008, 2008, 2009. What has been going on is several things. These banks, they have deposited money, and based on that deposited money, they then put into many types of investments that they invest. Now, banks don't need to hold on to the money that you deposit in them. They only need to hold on to about 10% of that money. And most of the other money is lent out. And depending on what they are doing with that money and how those investments are coming through is going to really show what kind of risk that the bank is willing to take in those type of circumstances. So in a few things I have raised a red flag about this particular bank that didn't have a risk controller from April of 2022. That position has been missed. And especially if you're in a financial institution, one of those type of roles is a must. And as things have been moved aside with the Fed increasing interest rates and people starting to pull out money from the banks in order to put it elsewhere, they felt that pinch. And all of a sudden, things started coming along very quickly and raveling very quickly. I mean, to the point that Jim Cramer, the guru of Wall Street in the U.S., actually called it a strong buy back in February 8th or February 9th of just this past February, which is only about 5-6 weeks ago. So with that said, it's really something that's very shocking to the market.
We've seen the U.S. President Joe Biden tweeting, and his tweets have been an attempt to reassure what has become a story that has moved quite quickly since Friday in sending shockwaves around. And one of such tweets that have to do with reassuring the public that these are the steps that are now going to actually take place. And over the weekend, he explains it did the same, the Federal Reserve locally doing the same with Signature Bank. And he tweeted that the management of this bank is going to be fired immediately. There will be no losses that will be borne by the taxpayer, as they will pay the deposits from the depositors from the fees that banks pay into the deposit insurance fund. And he went on to say that if a bank is taken over by the FDIC, the people running the bank shouldn't work there anymore, which is something that is of a reassurance to the markets. Investors, however, in the banks will not be protected. They knowingly took a risk, and it's a risk it is. It's high risk, high reward. But Fred, it doesn't seem that this tweet and this reassurance by Joe Biden has actually reassured the market at all, because currently banks as far afield as South Africa, UK and everywhere else in the world are actually down. They are tumbling. Why are we catching the cold from this sneeze?
So ultimately, when one fish gets sick, the idea is the rest of the school of the fish get sick as well. I don't think that that's going to be the case. I think historically speaking, there's always been a situation like this, not always been a situation like this, but very often, like if you look back to the Barings Bank, where there's a bank that takes extra amount of risk that's unnecessary and doesn't have a risk controller in charge. That position was vacant from April of 2022. Then these type of things can happen. Now, they happened to Lehman Brothers in 2008, where they came apart and they were one of the biggest players in the financial, landscape. So to say that these things never happen, they do happen. Now, do they happen, globally? Do they happen systemically? I don't think so. I think that there are enough, very well established banks internationally that don't take these risks. Now, at the end of the day, there's always going to be some kind of risk that we're all going to have to partake. But I don't think that this is a 2008, 2009 crisis. I think it's more isolated to this particular bank. But, ultimately, if things continue to unravel in the U.S. markets, then we will see some more insolvency. I don't think to this scale, but I think that there will be some, some treacherous waters that we're going to have to overcome. Not as much for the private citizen who has a bank account, but more to the investor. More the investing community is going to have a lot of turmoil within the markets in the next 6 to 12 months. But I think ultimately the FDIC does insure up to $250,000 of a deposit. So most people are covered. Ultimately, obviously the people that have more than that need to diversify themselves a little bit more. But I think also that, like I said, I think this is more an isolated case than something that's systemic.
Isn't it a risk, Fred, that even those who are managing the bank, those who are investors in the bank, take even more risk when it comes to these sort of assurances where you have the FDIC coming in to reassure deposits? Isn't that a risk on its own, making these investors and bank managers have a laissez-faire attitude towards risk management?
I think it's mostly it's purpose mismanagement. I mean, in this particular case, some of the top people in the bank were formerly some of the regulators. I mean, the CEO was formerly a Fed chairman for the San Francisco Fed, which is as legitimate as it comes. I mean, that's working for the Federal Reserve of San Francisco. So for him to have bypass this. I know he was taken off the board of the Federal Reserve of San Francisco, but ultimately it's mismanagement, it's misappropriation, it's greed, and it's unfortunate for those investors that did invest in this bank. Like you said before, the depositors are covered from fees or from something that we don't exactly know that the government is going to they said publicly that they're not coming to save the bank, but you could see that they're ultimately coming through in terms of depositors' money and making sure that they're getting their money back. But I think it's when regulators go to the other side and don't really adhere to the standards, that's where we get into some serious issues.
You've already answered this question in what you believe, Fred, that this is not just something that you will see happening more often, but many other punters are now predicting the fall of other banks. My question is, why is the most concern on the bond market itself, which we saw triggering the 2008 global financial crisis? Is that market, as volatile as it is it a safe market for now, as far as you can see there on the New York Stock Exchange?
So everything really takes us back to the interest rates. What the Federal Reserve will do, more so with inflation than as opposed to unemployment or consumer confidence or any of the other numbers that are coming out. I think everybody's focus is just laser focused at inflation. And I think as long as interest rates stabilize, I think we'll see stabilization in the bond market as well. I think this whole environment that we're currently in is just the unanticipation from the Federal Reserve that we would be in such a inflationary environment that we are in right now. And that causes panic in the markets, and that then causes panics in the bond prices. So I think that will stabilize as well once we see clearly how much further the Fed is going to staff off the increase of interest rates to staff off that inflation.
Fred Razak is the chief trading strategist at CMTrading in the New York Stock Exchange. Fred, thank you very much for your time this afternoon, telling us that there is nothing...